Hello everyone and welcome to this video about the variety of types of investments. And I will warn you, I keep a very surface level on all of this stuff because otherwise the video would be, years long. There are entire degrees dedicated just to this, and a lot of people who get those degrees still don't know all the answers. So, obviously a 10-minute YouTube video is not going to cover it, but I can cover it in small ways. Also, before I get started, not a financial advisor. So, I broke these down into safety levels, and here are some of the ones that I personally would deem safe in my life. Day-to-day quality of life improvements. To me, the vast majority of those are going to be safe if they do actually improve the quality of life. For example, my marvelous cat, who's currently taking a bath, was a pretty big quality of life improvement for me. She has also cost a reasonable amount of money, but she's very kind and social, so she has definitely improved my quality of life, and it was more than worth it from an investment standpoint in myself. And because I'm investing in myself with a known amount of money, it's very safe, right? I know who is holding the product at the end, and it is me. Though um, I'm sure my cat would argue that she's the one who got the servant. So, other more standard things would be basically stuff you can get at your bank, checking accounts that if they earn interest, savings accounts, money markets, and certificates of deposit. Uh, I'm not really going to go into the differences of all of those here, but generally they're insured by a federal agency in the U.S. At least they're insured by a federal agency that protects your money up to, it's like $250,000 or something. I don't know the exact amount of money anymore, but there's a cap on how much of your money is insured, but it's fairly high, and most of us won't run into it in any of these accounts. But that makes them very safe because they're theoretically protected, barring a total collapse of epic proportions, in which case money probably isn't your most important thing to think about anyway. And then there are safe investments. These are kind of pretty fun because if you talk to somebody who's a little bit older than me, they'll probably tell you that bonds are both safe and a solid way to invest money. I don't really subscribe to that. Um, and for that matter, property can be a very safe way to invest, but talk to some people who invested in commercial property right before the pandemic hit and ask them how that's going, or talk to somebody who invested in condos in Miami in 2007 I think it was 2007 or early 2008, right before the housing market totally crashed, and ask them how that turned out for them and how many years it took for them to come back. So the point is, some of these classic investments that some would from previous generations often would tell us are very safe aren't really anymore. Um, and bonds are getting somewhat less safe because it's a little bit of a concerning trend of municipalities and basically filing for bankruptcy, and that gets them not necessarily completely out of their bonds, but that means that you're very unlikely to see any return from your bond with them. So that is starting to make bonds less safe, along with the rate of return not being particularly good lately. So these are things that I call moderate risk, and I know, if you know a lot about the stock market and various other forms of equity, well, A, you're watching the wrong video, for sure. You are definitely watching the wrong video. But if you happen to be anyway, I know that these aren't necessarily moderate risk. That's not really fair. But if you're talking to um, somebody who's inexperienced, a lot of the things that they're going to find in relation to these are going to be less risk than just picking a stock and dumping all of their money into it. So these basically the idea of these is you're collecting related or unrelated assets that can be purchased, such as, I mean, you can even get some of these investing in realty or foreign currencies, or a more common one is specific stocks. And the idea is you're grouping them together so that in this one thing you have some diversification. So if something in this portfolio of like an ETF goes bankrupt, the whole thing doesn't die, right? You don't lose everything that you had in that ETF. So I'm classifying these moderate risk because you're diversified, kind of diversified. Now, there are some issues in that the value of your ETF can change and shift around without change in the value of underlying assets, because the company doing the ETF can go broke, or it can get kind of strange. But in general, if you do your research, I would classify this as moderate risk rather than high or extreme. So, things that are risky, not super risky necessarily, but I'd call regular risky. So I'll just let you peruse the list, but one thing I specifically want to call out is anything involving day trading, and that's partly because so much of day trading is just watching charts, and computers are really good at watching charts, and humans aren't as good, and they're certainly slower at it. So you're kind of going to be outpaced there no matter what you do by someone or something who knows more, at least in my opinion. Now, I know someday one person may find, well, I made lots of money on my day trading. Well, good for you. Like, actually good for you. I'm happy for you. Like a multi-level marketing scheme, most people don't, though. Now, that is a little bit unfair because I'm not sure day trading is deliberately predatory in nature, but it's most people do not profit. So, the other thing I'm going to call out specifically is precious metals. That somebody watching knows an uncle or a friend or a grandparent or whatever, right? You know somebody who buried silver in their backyard or has a huge stockpile of old silver coins or whatever the case is. And that's okay. I'm not telling people to not do that. But the value of precious metals now, so many of them, is tied directly to industrial value. And the industrial value of precious metals is based on, in a lot of cases, is based on supply versus demand. So if there's an economic downturn and the supply starts to outpace the demand, the value of those will drop on the open market. So now you have an asset that, depending on what type of metal it is, of course, and how much the earth has of it, you may have an asset now that is just tied to general industry. Well, just why not buy the stocks then, right? You went out through all the effort of burying 1.5 tons of copper in your backyard when you could have just bought a stock and gotten a better return with the same amount of risk. And obviously that's an extreme example, and copper in particular has been a very valuable metal as of late. But anyway, you shouldn't just assume that something like precious metals is safe. That's not how it works. And in my opinion, I would put them on the same level as stocks in terms of their level of risk. But I'm sure somebody watching this will disagree, and that's all right. Like I said, I'm not a financial advisor. So these are super risky. Monetizing hobbies. You may think, well, I monetized my hobby and I got $10 that I otherwise wouldn't have had. Fair point. But monetizing a hobby, when you do that, it's very easy to end up in a position of mental anguish, right? You have to spend a bunch of money up front to get your um, hobby monetized, or you end up with it running you instead of you running it, and you don't want to do it, but you kind of feel like you have to because now it's a source of income, and you can end up in mental and financial holes in that situation. Or even depending on what it is you monetized, maybe you end up getting sued over something that did went wrong with your product, or somebody got hurt, and all of a sudden you've got a lawsuit on your hands, so you didn't really monetize it, right? It's I'm not saying there's not reward there. I'm saying that it can be extremely risky for a lot of us. So that's something to think about. Collectibles. Well, we all know somebody who collects $2 bills, and we also probably a lot of us know somebody who collects Beanie Babies. All of those are worthless. $2 bills, Beanie Babies, even a lot of modern comic books are going to be worth nothing because everybody knows of, like, the first issue of whatever comic book from 1968 or something that nobody bought. So there's 10 copies in the whole world that are in good shape, and they're worth $1.5 million. But now so many people who buy comic books save them and keep them in really good shape, or as good a shape as possible. So I'm not saying don't buy and read comic books. I'm just saying that it's probably not a good, safe investment strategy. Um, and there are lots of collectibles like that. Almost anything that's marketed as a collectible is going to end up being kind of like that. Uh, so then there's cryptocurrencies. Full disclosure, I do have some money in cryptocurrencies, and I've dabbled several times in the past with them just because I think it's very interesting. But I would be a liar if I told you I thought it was anything but very risky. And the reason for that is it's a very, most, from most people's perspective, there's a lot of misunderstanding about what it is and what can happen to it and how it's run, etc. So that makes it an extreme risk for a lot of people when you don't know what it is or how it works or anything. You're just dumping money at it. And if you want to do something like that, I am always taking donations. And you don't know how I work or what I'm doing besides making this video, but I'm happy to take the donation if we're throwing money around. Um, Art can be very similar in that a lot of people think they get it and don't get it, and I certainly do not get it, except that I do know that a lot of the very high priced art stuff is not just subjective in the form of some people like it, some people don't. It's also subjective in the form of who has said what about that art or who made that art. Things like that. Like, it just, there are so many factors that have literally nothing to do with the quality of the piece or the style of the piece or the age of the piece that I would call it an extremely risky thing. Unless you happen to have enough money that you can just pay somebody to say it's amazing. Uh, Cars are another thing. It's so hard to tell what car is going to be a solid investment for later, and the vast majority of them end up being effectively worthless compared to what you have to spend to keep them in decent shape over the years. And we've all heard the timeshare thing. I won't really rant about that. But that timeshares can be okay for some people, but I'd call them pretty much worthless for almost everyone. And even the people they're okay for, I would not call them a good investment. But Who knows? Maybe you get lucky and your timeshare clause, you end up owning the thing after 30 years of paying on it, and it's in that 30 years it's gone up 10,000% in value, right? It's not impossible. It's just, what are the odds, right? What are the odds? So, um, that's this video about a bunch of the different types of investment. I'm sure some things I said weren't especially popular, but feel free to let me know in the comments. I'll see you all in the next one.